Hi everyone, my name is Aldi and welcome to Enterprise Risk Management Academy. In this video, we're going to be talking about upside risk and downside risk. These are the two key concepts in enterprise risk management. Us, humans, respond to risk typically in a defensive manner, right? In fact, our brains are built to help us survive. So we usually focus on the negative, the things that can go wrong, the potential losses or damages that can result from a particular event or decision. This is what's known as downside risk. It's the risk that we're most familiar with, and it's what we typically try to mitigate or even avoid altogether. But there's another side to risk as well, the upside risk. This is the potential for positive outcomes and opportunities that can arise from taking a particular action or pursuing a particular strategy. Upside risk is less well known than downside risk. That's a bit unfortunate, to be honest, but it's just as important to consider when managing risk and making decisions. Referring to the definition of ISO 31000, risk is the effect of uncertainty on objectives. The risk itself is neutral. The thing that can make your risk look more negative or positive is actually the effect. So these effects makes the deviation from what you expect with the actual condition. And this deviation could either go positive or negative. So the question is, how do we distinguish between upside risk and downside risk? Well, one way is to think about the potential outcomes of a particular decision or action. If the potential outcomes are largely negative, if there's a high risk of loss, damage or failure, then we're dealing with downside risk. On the other hand, if the potential outcomes are largely positive, if there's a high potential for gains, growth or success, then we're most likely dealing with upside risk. So now let's take an example. Suppose you are a startup founder trying to decide whether to invest in a new product line. If you focus only on downside risk, you might be hesitant to invest because of the potential for failure, the risk that the product line won't take off and you lose all of your money. But if you also consider the upside risk, you might see the potential for the significant growth and profits if the product line is successful. So this could make the investment more attractive, even though there's still a risk of failure, of course. Therefore, you could exploit the risks to have more opportunities while mitigating the potential harm or loss throughout the process. And that's how you can optimize your risk management. So, why is it important to consider both the upside as well as the downside risk? Well, for one thing, it can help you make more informed decisions because again, ERM is all about decision making. It's essentially a tool for making better decisions, right? So if you're only focused on downside risk, you might miss out on opportunities that could lead to significant gains. And you don't want that, do you? But if you're also considering upside risk, you might be more willing to take calculated risks that could pay off in the long run. Also, considering both types of risk can help you prioritize and allocate resources more effectively and more efficiently. If you're only focused on downside risk, you might be over-investing in risk mitigation strategies while neglecting opportunities that could help your organization grow and thrive. But if you're also considering the upside risk, you can make more balanced decisions and how to allocate your resources more effectively. Right, so in short, upside risk and downside risk are the two key concepts in ERM that are very often overlooked. By considering both types of risk, we can make more informed decisions, prioritize resources more effectively, and position our organizations for long-term success. Thanks for watching, and we hope you found this video helpful. Don't forget to like, comment, subscribe for more educational content like this. I'll see you next time. Cheers!